Many of us investing through mutual funds have an urge to invest in stocks directly, although we may lack research resources and time. However, an itch does not go away without a scratch. So here is a way to do it. Use this only as a pointer for your further research. Do not construe this as an advice or recommendation. We go to screener.in and enter this query to identify stocks that have a market cap of greater than 40,000 crore. We want to avoid small companies and be with the safest, largest companies, preferably part of the top 100 in the Nifty, and hence this limit. We then want to identify companies that have generated at least 25% return on equity consistently. Let's ensure that these companies have no debt or very low debt, because debt can kill a company however good other matrices are. Finally, we want margin of safety while investing. We want these great companies at a discount, quoting less than 30% from their highs at least. We get about 8 names. Remember, at times in the market, you'll be spoiled for choice during uncertain times, political turmoil, panic such as COVID times or bankruptcy. But at other times, we may not have too many options coming. This means market is at a high. There is too much optimism, euphoria, greed in the market. This is the time to sit on cash. The best banks will have to be screened separately, as this will not pass this debt filter. Let us also not include public sector companies, commodities and other cyclical businesses, because they require a very different type of analysis. These stocks are not only the best business, but are also available at 30% discount to their all-time high prices. Now, we need to do another additional check. Are these companies generating high profits? The latest net profit of Infosys is at an all-time high at 24,000 crore. It is the highest in the past 10 years. Also, the profits have been growing consistently every year. Yet, the share price of Infosys has corrected by 33%. So, if the stock goes back to the previous high from here, it will fetch us a decent 52% return. The reason for stock correcting? US recession and inflation, and the fear that this could dampen the IT sector. As always, good news and good prices do not come together. And this is not the first time it has happened for a stock like this. Every time the stock has corrected, it has regained its old high. It might take time, perhaps 1 year or even more, but still a 52% return is gold. Remember, we are talking of the country's best companies and not junk stocks in this strategy. Now, let us look at another stock that has corrected more than 30%, HDFC AMC. Here again, if you see the net profit, it has grown from 319 crore to 1,420 crore in the recent past year, registering highest ever profit in its history. Yet, the stock has corrected 39%. And if the stock goes back to its all-time high price, that's a gain of 64%. Again, the reason for share falling is similar, bad sentiment. In this case, SEBI is likely to cut the expenses that these AMCs charge their customer. And good management always grow their business, as is clearly visible in this case. Third example, Devis Lab. The stock corrected 35%. If the prices go back to its all-time high, that's a 52% gain, even if it takes a year or two or even more. So the investor needs to keep patience. Profits have been growing, but this year they appear to be low due to very high growth of moluperivir drug during the preceding COVID years. That's just getting adjusted now. Bad sentiments and negative news will always allow us to buy great companies at a great discount. We buy them and then patiently wait for prices to go back to the previous high. So this strategy is a combination of 30% or bigger fall, which gives us a high margin of safety, plus highest ever profit in recent year, and companies also growing consistently. Never invest more than 3 to 5% in one idea. That gives us diversification to manage unknown risk. Great companies which have excellent management always finds its way to keep growing despite all the tough environment. This is just a broad direction. You can make changes to the script. For example, you may want to allow companies that have a lower market cap. Now you will see that you suddenly have 19 stocks. You can also allow companies with higher debt, and to be doubly sure of the quality, you can add Piotrowski's score of a minimum of 7. When great businesses experience sharp corrections, it presents an opportune time for us to invest. It happens because our brain is wired with recency bias. Too much of importance is given to immediate events. The only factor affecting their stock price is negative sentiment and not the business per se. This creates a special situation for investors like us. Please read additional notes in the comment section and do like this video if you got this far.